So today's webinar is really interesting. It's about how to speak with and talk with your bank during these difficult times. And the current environment with COVID-19, many banks are assessing risk in a different way, but understanding how banks think will help you figure out the options you have to finance your business through this difficult period. So it's my pleasure to introduce the two panelists. Cam Wallace is the Head of Performance and Insights at the BNZ. For 20 years, he worked in the electrical engineering business, joining the BNZ in 2016, after, in fact, a short period at the Ice House. So Cam is a good friend of the Ice House. Welcome, Cam. The other panelist is Tim Wixon. Tim is the Head of the Tech Industry at the BNZ and manages all of the technology industry portfolio companies that the bank serves, helping with the community across New Zealand, focusing on business development, coaching, strategy, thought leadership, and transaction advisory for the bank. So a couple of great guys for this topic. So I'm going to share my screen and help guide through a conversation, but most of the talking will be done by Cam and Tim. So let me just see if I can share my screen here. Go. Great. Can you guys see the screen? Just nod. Yep, you're on mute at the moment. So the first question I have is, when would a business interact or start talking with a bank about funding? Because obviously companies go through different stages.
Yes, great question, Gavin, thanks. So from our perspective, we like to talk to businesses early, but from a funding perspective, we tend to play a little bit later than certain other investors. So I think this slide here gives a really good rundown of different funding sources and I guess where the bank may start to play versus other forms of financing, equity, families and friends, etc. So I guess the headline comment I always make is that the bank, in terms of funding, is required to make a financing decision to lend money to a business, so at-risk money, and we only get a fixed return on our money that we put in and fund into a business. So we've always got limited upside. So our risk-reward trade-off is different to other forms of financing or equity. And so this is a really traditional way of looking at it on this graph. And obviously cash flow is one of the biggest single drivers in terms of what we look at from a financing perspective. And profitability tends to be important as well. So this has banks playing obviously at that more mature stage of business. We do play a bit earlier than what this graph shows, and it tends to be around that break-even point and forwards. And I guess from a tech industry perspective, because that's always my bias, we tend to look at things around that inflection point of break-even and as they're starting to cash flow forwards. Okay, great. So that makes perfect sense. Banks are really there for going concerns, not very early stage companies that are pre-profit. So the next question and the key question really is, how do banks assess the risk when a business comes to a bank? What is the bank thinking?
Yeah, that's also a good question. I guess, you know, in pre-Ice House and pre-BNZ, I was a business owner and I really never understood how the bank worked. And fundamentally, this is probably my favorite slide in the bank, because I think if you understand this slide, you'll understand whether the bank's going to lend you any money or not. I guess where lending from a bank point of view is easy is where security is high, right, and cash flow is high, right, and all banks will play there, right. So effectively, if things go wrong, there's lots of security, so the bank knows it's going to get its money back, right, and because the business is a really good business, it's got stable cash flows, which means that, you know, it's going to be profitable now and into the future, right? So this is dead dog easy. Every bank wants to do these deals, and it will be a race to the bottom in terms of how cheap you can get the capital. But that's only one part of the puzzle, right? At the other end of the scale is the real tricky stuff, right? This is where there is limited security on offer, right, for the bank, should everything go wrong. And I guess the cash flow is really unstable. What I mean by unstable is it could be a really heavily seasonal cash flow, or sales could go up and down like a yo-yo, or, you know, it's all project-based work rather than work that comes in month by month. So there is, you know, limited run rate, and that you know, lack of cash flow stability really increases the probability of default. The other bit of the puzzle, I guess, is where you've got really good security, right? But bugger all cash flow, right? And this is also a really tricky space for the bank, because there's a whole lot of reputational risk in here, and banks don't want to be on the front page of the Herald. And I guess, you know, and think about a situation where you've got a whole lot of property assets, which are very high quality assets, but they don't generate, you know, a heck of a lot of free cash flow. Then if it all turns tricky, right, then the only way out is to sell those assets. And banks really aren't in the business of wanting to do that unless you're absolutely the absolute last resort. It's not our preferred option. So that really leaves, I guess, the top left-hand corner, which is, for guys like Tim and I, it's the favorite part of the puzzle. It's where you've got businesses, and tech businesses are a really good example, with good cash flow, limited security, but good people running them, good management, you know, good market positioning, and that cash flow effectively supports the lending.
So then, if you look at the this model here, you've got a couple of dimensions that you mentioned to me before this. Could you talk through this slide?
I get this is pretty simple. Banks aren't rocket science. We're not going to the moon here. We're trying to lend people money and have them use that to do well. I mean, Porter's 5 forces and business industry risk is something that banks are going to take a real close look at. And in the COVID operating context, if you think about the worst case, right, business industry risk and tourism would be through the roof right now for obvious reasons. The next bit, I guess, banks are always going to look at the who. The first rule that they teach you when you join the bank is, if you don't like the who, in terms of the who that wants to borrow the money, you run away as fast as you possibly can. So that's really the who, is the management, the team, their advisors, how they work together, the sort of quality of the business, the systems and processes. It's how classy the operation is. And then the last component, I guess, that drives, I guess, you know, our ability to be able to lend businesses money is how stable the cash flow is. Again, if it boils back down to the fact that the cash flow goes up and down like a yo-yo, sales are up and down like a yo-yo, the business is heavily Capex or capital intensive, then you know, that's going to impact the way that we view a business. And all of those three things added together, you know, you come to a landing on where the probability of default is, right? How likely is the bank to get its money back effectively?
Right. And you really want to, you know, what that probability of default to be low. And you mentioned this is like the first exit, and you, interesting enough, you talk about a second exit, which describe this slide to us.
So this is Cam's slide, but I'm going to describe it. It's definitely his style of imagery here. So yeah, we always look at, so what if things go wrong, right? So with all the goodwill and foresight and predictability and forecasting in the world, sometimes things go wrong. And we make an assessment of that at the outset. So what are the options if the cash flow, so your primary exit for a bank, which is always our preference, doesn't work out? And there's a whole range of things we look at. So the most obvious one that everybody knows are the tangible assets to sell down. So everyone's more familiar with machinery, buildings, etc. And I guess we're also getting a bit more sophisticated in terms of looking at what intangible asset bases look like, although harder to value. So as Cam pointed out, one of those key unlockers for tech industry is understanding that side of things. And I guess there's two questions there as well, and the next slide will talk to it. But we look at it from I guess a certainty or uncertainty into that concept of risk as well, in terms of how we make this assessment. And there's a whole lot of proxies we can use where there's a little bit more uncertainty to get some predictability around what a second exit might look like. But yeah, it might be sale of a business, sale of assets, sale of components of a business, and a few other things.
So we're trying, obviously many businesses are trying to avoid this situation. This is kind of the worst case scenario, but there are obviously different phases, even for going concerns, that different types of funding decisions are made. Maybe you could talk through a couple here. Actually, this is the slide that kind of summarizes the previous points. We'll move on to the next one. Who would like to talk to this one?
Yeah, I'll just quickly run through this as a backup to those last comments. So we put every business through a risk model internally, and it gives a rating on a number scale. And the gist of it really is it's got a probability of default, which ties around cash flow, and some qualitative questions around management quality and some of those Porter's 5 forces that Cam pointed out, and also the recovery value if something goes wrong. And the long and short of it from what that means from a bank perspective, one is it dictates where we play in terms of our appetite to lend, but it also drives pricing, right? So basically the lower the probability of default and the higher the security or recovery value, the less capital the bank has to use or apply to that business lending from a reserve bank and capital adequacy requirement perspective. So you get a lower price on your debt facilities.
So one of the things I know that we'll be talking about a little bit later is the government-backed debt that has been introduced previously when the COVID lockdown took place. And I know that the government have updated recently some of those terms. So I think that the audience will be interested to understand what the latest news is there. And that would also affect, hopefully, the price of debt for companies as well. So if we move on to the question I asked before, which is, you know, the different types of funding forms, what about this one in terms of funding working capital gaps in companies?
Yep, so I'll cover this quickly as well. So working capital is the easier form of funding for us. So I guess we look at two things. One, working capital is easier, we can put it in earlier, and we like funding that shorter term cash flow cycle for businesses. And we've broken it down into three types here, which are three types of funding we put in from a working capital perspective. I'm going to start at the bottom and work my way up actually. So for overdrafts, the most common, we use that for day-to-day, week-to-week, month-to-month cash flow timing mismatches. So think of wages coming out before your 20th of the month billing and rental and etc. So overdrafts are really good for funding that side of things. Trade receivables is funding post a sale of a good or service. So that's really looking at your lag between when you deliver either a good or a service and collecting in your receivables. And we've used that really successfully both in a domestic market and on international revenues as well. So it's really attractive. If you look at tech businesses and exporters, that becomes a pretty attractive way of funding. And also it goes multi-currency as well. So we can fund in the currency that your invoice is in. And then there's also this trade finance payables type scenario where we're funding, so this is before you've sold goods and you're funding a whole range of inputs. So it's more like your cost of goods sold that go into a product, and there's an uncertain exit, if you like, or uncertain cash flow that comes off that. So you have to sell down that in the future. So those are all really good forms of short-term funding depending on your business model.
Yeah, I mean, they make perfect sense, and I've been involved in a couple of businesses where the BNZ have been supporting those businesses and, you know, getting finance for where you sold a product. You have invoices issued, the customer's waiting for the products, and you're having to fund working capital through that period of high capital, you know, input products. That the bank is very often very open to that type of situation, given the risks are relatively low. What about this other type here, asset finance?
So asset financing is funding against a certain asset, and the pictures pretty much sum it up, right? So and they get better security value, so they tend to be an attractive form of funding from a bank. So some of those comments we made earlier. So your classic is vehicles, yellow kit, machinery, etc. that goes into plant, and so you tend to be able to get a slightly longer repayment curve on those, and we have some offerings that play in a working capital and a term debt space for those types of assets.
Okay, well that's useful to know. Now you're heading up technology at the bank, Tim, and what are the different? How would the technology industry be characterized in this? Obviously, many tech businesses don't have tangible assets. Many of them are, you know, software related. So how does the bank view that?
Yeah, it's a great question. So so these sit in that feasible part of Cam's earlier graph for sure, from both a, I guess, traditional way that Reserve Bank and capital requirements work. And so for us, I mean, it really comes down to I think the cash flow drivers of tech businesses are actually quite simple to be able to understand. So the key is just understanding quite how strong those are. The second part that's the real key is unlocking and understanding intangible assets. So I guess the key things for us, and I've put them on the next slide as well, you know, we're keen to see businesses thinking about where the key value drivers are of their business quite early, making sure they understand those, making sure that they've captured those so that they've put some forms of protection around those, whether that's intellectual property rights, confidentiality, contractual arrangements, etc. And I guess my nirvana state in the future is we're going to have a really strong way of valuing those, a bit like the trucks and buses and buildings and things that are much more easy to value at the moment. So I guess that's a time thing as well. We're going to have more examples of transactions and equity raisings and valuation metrics that will apply to tech businesses. And we use a range of proxies for how we value tech businesses at the moment. It's probably a bit of a longer conversation than we have today, so I'm always happy to chat through with anyone who's interested. But a lot of it comes back to those key focus points, A to D on the slide there. So quality of revenues, high gross profit margin, understanding the cost structure, and I guess the most key one is just there's a whole range of lead indicators we look at for both cash flow and value. And we're getting much more sophisticated around how we look at those and the understanding. So unfortunately, those don't sit in your traditional financial accounts that we receive, but we are keen to see those and understand them as well.
Well, it's good to know that the banks, have specialists who understand the different dynamics and structures of industries, and particularly the tech industry, which, as your previous slide indicated, is so vital for, the future growth of New Zealand's economy. So many of the people listening in here will be particularly interested to understand what they should do right now in the midst of a lockdown, and what services and bank backups are there from the government, and how should they approach their bank in that context. So what are the considerations?
Well, this has been a fascinating time, and for the last couple of months I've been up to my neck in understanding all of the customer-centric stuff within the bank, and I guess fundamentally it boils down to a couple of key considerations. The first one is risk appetite, and obviously there are some industries which COVID has brought in a sort of game-changing impact, and we mentioned tourism. You kind of put some hospitality in there, right? But there's other industries which actually haven't impacted COVID, and they've done a whole lot better as a result. So you've definitely got businesses and sectors at either end of the spectrum. You've also got certain regional geographies. Queenstown's a common one to call out, but you probably also put Rotorua in that bucket, and elements of the tourism industry in Auckland, to be honest, where there has been an over-indexing of the COVID impact. So I guess in terms of risk appetite, the bank's definitely considering, what impact the virus has had within individual sectors or industries, and then where your business is. And some of them aren't obvious, right? Because there's a whole lot of businesses that serve the hospo or tourism industry in Queenstown, which, while they're not tourism businesses, will suffer because tourism is down. And that really means that the bank is going to look pretty carefully at what security is on offer if, push comes to shove and the first exit is not looking good. I guess the other piece goes back to some of those fundamental principles we talked about, 20 minutes ago, is around the quality management, business viability, how good the plan is, making sure that the assumptions and sensitivities that a business owner or leaders are putting forward make sense, how stable their cash flow is. And also, I guess I just cannot, undervalue track record, right? If you're the sort of business that puts forward a good plan and then delivers on it, and you've got a track record of doing that with the bank, that's going to give the bank a whole lot of confidence in the way that they deal with you. If you're the sort of business that puts a hockey stick forecast or a fairy tale in front of the bank and then never delivers on it, that's going to be a really difficult proposition for the bank to bank back, especially when times get tough.
Yep, that makes sense. So what options are available, Cam?
So the options are sort of unfolded as COVID has unfolded, right? And there were, there are a whole lot of home loan options, including the mortgage holidays, which most people will know about. A whole lot of people moved their home loans to interest only, or deferred them, and those deferrals, the first tranche of those deferrals are sort of coming up now, and the government's just extended those to March the 31st, the ability for banks to sort of, help customers defer for a bit longer. In terms of the business piece, there were temporary ODs. A lot of businesses moved loans to interest only, on whether they were term debt or asset finance. A whole lot of people had their trade finance, their receivables or payables loans extended. So if it was a 120 or 150 day loan, it was extended to 180 or longer. There was a whole lot of standard business loans which people took out in order to sort of bridge the gap. And then there was this thing called the business finance scheme, which is really where we're getting to the rubber meeting the road and the sharp end of the stick. Because when the business finance scheme originally came out, it was a complicated beast, which was very, very poorly understood. And I think the confusion came originally, Gavin, because of the name of it, right? A whole lot of people were used to wage subsidies and handouts or there was and this BFS loan thing came along, and people just weren't sure what it was, and they thought it was effectively another government subsidy rather than a loan. So that caused a heck of a lot of confusion and probably got it off to a really poor start.
Yeah, I mean, the stats on that are such that I believe only about 2% of businesses took up that. The government backed, I think, $6 billion of loans, but very few of them were taken up. So maybe you could take us through. I know there's quite a bit of detail on this, and obviously people will get the video, and if they need the slides, they're happy to have them. But what are the key points about the scheme when it was launched?
I mean, the bottom line, mate, is that it was too complicated, right? It was a very complicated scheme, and the government stuck their toe in the water with banks to figure out, to try and come to a landing on something that might work, right, at quite in the early stages of COVID. But fundamentally, right, the key thing and the key point on that slide is that the business finance scheme is a loss sharing agreement between banks and the government. So it's a loan. It works like a normal loan would. And if the loan fell into default, right, then the government would step in alongside the bank and pick up 80% of the amount that was owing, right, once all of the recovery activities had taken place. Yeah. So, and the bank and the government would share that on an 80-20 basis.
Yeah, but I know that the banks were also obliged to use their same public sector borrowing requirement terms associated with that. So maybe rather than dwelling on the past, maybe you could talk about what's just been announced.
Yeah, correct. And what's been announced is game changing. So the fact, Grant Robertson at 3 o'clock yesterday afternoon announced the changes to the business finance scheme. Previously, the limit was $500,000. It's now $5 million. Previously, the borrower's turnover could be maximum of $80 million. It's now $200 million, which means most businesses in New Zealand will qualify. Now the loan term is 5 years, and most banks will do amortization up to 7 years, which means from a cash flow point of view, that's going to really help businesses. The key thing, I guess, is that Capex restrictions have been removed. There were Capex restrictions in the previous iteration. There are now no Capex restrictions. You can basically use the loan for what you like, and you can refinance existing debt, up to 20% of your existing debt onto a BFS loan. Why would you do that? Well, actually, that's because BFS debt is cheap. The rate, the all-in rate is around about 2.3%. Will be, a little bit above or a little bit. That's a pretty middle-of-the-road rate. So the government has effectively allocated quite a large pool of very cheap funds into the business ecosystem, and provided that businesses can demonstrate servicing of that debt, then they've got access to capital. And really, the spirit of this is actually short-term liquidity relief, Gavin, but also to help businesses drive economic activity, employ people, do stuff, grow, and try and get us back to a sort of pre-COVID levels of economic activity.
Yeah, I mean, that makes sense. I know some of the restrictions on, the reasons what the money could be used for were off-putting. Some of and the restriction previously of only going up to $500,000 really restricted the types of businesses, and now up to 5 million extends, companies that are up to 200 million, which actually captures probably the vast majority of firms in New Zealand. So that's positive. And I think the real thing now is, if businesses are interested in this, they should contact their bank and work through the details on the revised application, which I guess was announced only yesterday, right?
Yeah, correct. And the revised application the process has been simplified. I mean, in essence, normal lending criteria apply. So a business can't borrow money unless they can demonstrate the ability to be able to service it. So we've got to make that clear, right? But provided they can service it, then I think the process is sort of smarter, better, faster, slicker. And that's precisely what we as a bank think that businesses in New Zealand need: access to low-cost capital in order to be able to do stuff and drive economic activity that's going to employ people and see us come out the other side of COVID.
Yep. Okay. Well, that sounds like a really positive step, which is great. So we've got about 5 minutes to go. Actually, a bit less than that before we open up to Q&A. Actually, I'll just remind the people on the call, if you do have any questions, please feel free to put them in the Q&A function in this Zoom call. So are there any final points you'd like to add here, Cam? And I know you've got 2 or 3 just final sum up points at the end as well.
I guess the recovery plan as a business owner, right, is a total deal breaker, right? If you've got a rubbishy plan, then you're going to struggle to twist your bank's arm to back you. So that business plan and the ability to be able to show the bank that you've thought through it carefully, you've looked at your sales, your costs, your margins, you understand your cash flow, you've applied some assumptions, you've tested the sort of sensitivities. What happens if turnover falls by 25%? What happens if gross margin slips from 35% to 29%? What are the impacts? And I guess if your business is not in a break-even situation right at the moment, then the time to get back to break-even is a real critical factor from a bank point of view, because what that does is give us a really firm feeling of how soon the bleeding or the cash flow bleeding would stop. I mean, Tim, how do you see that bit?
Yeah, so I agree, and I actually think it's interesting. This is the sort of stuff that we expect to get anyway for a financing proposition to that initial comment I made, right? We're making an at-risk money decision on a business at a point in time. So it's really the same fundamentals apply. It's just a different context that we're playing in at the moment. So I think we've probably started to understand businesses better than we ever have through this COVID-19 environment, which is one of the silver linings, I think, from a bank and client relationship perspective.
Yeah, that's really good. You know, ultimately the message is talk to your bank, build a relationship, and you know, have a good handle on what your business is today and in the future. So are there are I know you had a couple of summary points here, Cam and Tim. I don't know who wants to talk through these, but you know, I think the message you highlighted here, out of adversity comes opportunity. I think you've talked about one of those, Tim. But here are your three final thoughts.
Yeah, I guess, I mean, just picking up on that adversity opportunity thing, right? There is definitely opportunity here using BFS and using the environment for consolidation, right? And I've already had a number of people talk to me about the ability to use BFS to buy out mum and dad or buy out a shareholding in a multi-generational family business. We've already had people talk to us about how to use BFS to invest in plant and equipment, right? To be able to do something new, or how to, I guess, build their business for the next stage, or digitally transform their business. So I guess, you know, or I guess how to buy your competitor, right? To be honest, right? A number of, again, we've fielded a number of queries about this over the last 24 hours. Could BFS used to buy another business within your industry and consolidate, and perhaps a business that you know might be struggling? So yeah, I mean, there are all of those parts of the puzzle. And I suspect that we're going to see some rationalisation along those lines over the next 6 months. And I guess, Tim, do you agree with that?
Yeah, I agree. Yep.
So, you know, what you're saying here is you need a plan. You know, you need to look at the ecosystem and not isolate and shut down, but talk to your partners, your supply chain and your customers. What's the second point here you'd like to raise?
I guess, you know, this is pretty straightforward, right? When it matters, be clear. Banks deal in facts. They're pretty analytical places, right? Just saying she'll be right or it's going to come right is not going to be enough for your bank. They're going to need, you know, a really clear, well thought through plan, whether you want to borrow some new money or whether you've borrowed a whole lot of money and now you're thinking about, you know, the future and how you're going to pay that back. So I guess, you know, my experience as a business owner was variable with the bank that we banked with. It wasn't the BNZ. But I didn't really understand, I guess, how the bank thought, and I hope that message has come through loud and clear here. And I guess building that relationship with your bank and being transparent with them so they've got a good picture of what's going on is mission critical in order to get what you want.
Okay, and the final point?
If you don't know who Hans Christian Andersen is, Gavin, I said, well, guys our age, well, I guess.
I do know who he is.
He was a fabulous writer of fairy tales. So fairy tale applications are probably not going to go down like you know, a ton of bricks at the bank. And I guess, you know, what we see is that businesses that are excellent, it's a habit, not an act, right? It's continuous. They just deliver and deliver and deliver and deliver. And that's not the Fish and Paykel Healthcares, right? That's the mum and dad businesses that are turning over $2 or $3 or $4 million or $20 million, right? They are genuinely excellent. They're stable. They're well run. And when they come, they don't bring fairy tales.